Well, my name is Mariano Giralt. I'm the head of strategy and business development at Raquest. Raquest is a fintech company specialized on withholding tax processing, and we collaborate very closely with our WTS Hansuke colleagues. And I would like the super panel to introduce yourself. So we start with you, Michelle.
Thank you, everybody, and it's a pleasure to be with you today. My name is Michelle Harding. I am a senior advisor in the Director's Office at the OECD Centre for Tax Policy. Until recently, I was the head of the Tax Data and Statistical Analysis Unit at the OECD. The OECD, you'll be familiar with it, but it's an organisation with 38 member countries and 8 more countries on the accession track, based in Paris. But it is a member-led organisation, and it works across the spectrum of government policy, except for defence. Notably in my area in taxation, where we have 2 major bodies we work with that go well beyond OECD membership. We have the Global Forum on Transparency and Exchange of Information for Tax Purposes, which has 171 member jurisdictions, and we have the Inclusive Framework on base erosion and profit shifting with 147 members. And so much of the work I talk about today is going through one or both of those bodies.
Very good, Michelle. Thank you so much. Jörg, please.
Thank you very much. Great pleasure to be here and great presentations and panels this morning. I'm the odd one out here, not because I'm from Switzerland, but I guess I'm the only one that doesn't have tax in the job title. So I work for Six Financial Information, and we are basically producing data. Data mainly on taxation of investment products. So I guess you can call myself a taxonomist and a taxologist, and really happy to today discuss with my colleagues here about what Six Financial Information does in the digital asset space.
Very good, thank you very much, Jörg. And everyone knows Roger, right? So everyone knows Robert, so I think we are going to skip from him. And before we are diving into the panel, guys, I want to ask you a question. How many of you hold in your portfolio, in your personal portfolio, some digital assets, some crypto, some tokenization, some NFTs, whatever? Raise your hand, please. How many of you are holding digital assets in your personal portfolio? This is around 20-ish% of the... I'm gonna extend the question because I want to see more hands. How many of you or your family members, your son, children, your relatives that know that they are holding any digital assets portfolio? Raise your hand. All right, so we are now around 30 plus, okay? So you asked this question 10 years ago, and we didn't have almost any hands, right? So 30+% of the people here are raising the hands. I want to share with you guys some numbers, some statistics that I got from ChatGPT. We're talking about AI as well, right? So I was using ChatGPT this morning to get some insights. And I validated the data, by the way, right? So I did the homework. So as of today, 4.2 trillion is the total market cap of digital assets. 4.2 trillion. In crypto, stable coins, tokenized assets. So in 2023, a couple of years ago, the total market cap was 1.7 trillion. So 2 years ago, 1.7 trillion, today 4.2 trillion. Just to put into perspective, right? The gold market cap is 15 trillion. So as of today, the digital assets market cap is around 27% the size of the gold market cap, right? Which is quite astonishing the way it's evolving. Another data: 500 million crypto users today worldwide. 500 million crypto users. This is a 40% increase in the last 2 years. 40%. Another data: 80+ countries piloting or launching CBDCs, central bank digital currencies. 80+ countries exploring that. Another data: nearly 40% of the institutional asset managers now include digital assets in their portfolio. Nearly 40% of the asset management, institutional asset management, are incorporating digital assets in the portfolio. These are quite interesting numbers, right? The last data, and it's a tax-related data, and then you guys are going to talk about it. 30+% of the tax authorities or countries are implementing crypto tax rules today. 30+ countries are implementing crypto tax rules today. So guys, we had a digital experiment in 2009, which was called the Bitcoin. And the Bitcoin today is more, the value of one Bitcoin is more than $100,000. So has gone a long way in just 16 years, right? So the way of this experiment came into place to where we are today on the digital assets space. So it's very timely and very welcome to have this conversation with you guys today to talk about these digital assets. So I'm gonna send the first message and the first question. I want to hear a little bit the story. How do you feel digital assets are evolving, and how do you see digital assets are impacting, let's say, traditional finance? So we start with you, Michelle.
Well, thank you. I note that now I'm the odd one out because I think I'm the only one on the panel that doesn't have holdings in crypto assets. So I've been working on crypto asset taxation since late 2019, and that was in response to growing interest from our member countries, and notably from the incoming Saudi presidency for the G20 in 2020. So we conducted, my team and I, a study on the taxation of crypto assets in 2020, and then did subsequent policy work after that. And one of the statistics you cited just now resonated with me, because you said 30% of countries are instituting guidance and rules for the taxation of crypto assets. And that tallies with what we are seeing, because back in 2020 there were very few countries that actually had got guidance on this issue. There were a few leaders, including the United Kingdom, but things are moving, and they're moving slowly, and we are seeing a broader awareness of the challenges that crypto assets pose for tax systems and for tax administrations, and a greater awareness of the need to provide guidance for an asset class which is quite unique. So that's what we're seeing from a taxation perspective.
Very good. Thank you very much for sharing. Jörg, what do you see? How do you see evolving the digital assets? How do you see it's impacting as well traditional finance?
So I'm going to kind of throw in a number as well, but it's not going to be a trillion number, but I think it's something very tangible for the audiences as well. So SIX Financial Information has a gigantic database of financial instruments, ranging obviously traditional instruments to derivatives, structured products. And we have built up this big database of financial instruments, not because we think that's just fun, but one of the functions that SIX has as well is we're a national numbering agency for Switzerland, Liechtenstein, and Belgium. And therefore, we are part of the standardization, the ANA Service Bureau as well. So really one of the key things where SIX is making a difference with data is to provide identifiers. Okay? And together with identifiers, we then have a set of reference data attributes that describe a financial product. And that has really worked extremely well for traditional products. So along comes this evolving world of digital assets. And suddenly you're faced with questions, well, does this thing have a security identifier or not? And what we have been able to build up over the last 5 years is actually to have 85% coverage in terms of cryptocurrencies. So 85% of the market cap, where we have financial instruments with ISINs, with other security identifiers, with the classification of the financial instrument. So we can say we really cover the digital asset space for cryptocurrencies. Along with that, we have also been able to cover, well, let's call it CARF-relevant instruments that are not cryptocurrencies. Because what we're doing is we're applying the technical definition of if something is a token, based on DLT, we apply this to other asset classes as well. So currently, we have over 21,000 instruments that are already marked in our database as CARF relevant because they are tokenized. And amongst them are surprisingly a few hundred of digital bonds, digital structured products. They are tokenized assets. And the important message I have for you here is you don't really necessarily see that on the instrument this description. So what SIX is actually doing is we're going into the white papers, we're going into the term sheets, we're going into the prospectus, we're using AI to extract all the information we can find in there. So if there's any evidence in these prospectus that indeed you have a digital asset, even if it comes in like the clothes of a traditional instrument, we're able to identify, to mark it, and then classify it accordingly. So I think what we're seeing is just an increase of those digital assets as well. The vote has shown it, it's just in everybody's portfolio. So all the banks that kind of work with SIX data, it's a reality already in all the investor portfolios that there is some sort of digital asset. So we've seen an increase, definitely an increase in that. But the really big number, big numbers here, we're not talking millions, but is really instruments that have an exposure to a crypto reference asset. Mm-hmm. So that's really, for us at SIX Financial Information as well, a really growing asset class. You wouldn't believe how many structured products, warrants are being opened where a tokenized asset is just an underlying asset to track this. And this shows me that beyond just cryptocurrencies, there's something there about like the technology, the blockchain technology. So what we're seeing as well are investments through those structured products into ultimately the promise of the technology of digital assets beyond it.
But these products are traditional products that they are holding underlying digital assets products, let's put it this way.
Correct.
Right.
But you can have a mix. Sorry. You can even for a structured product, so that is a certificate. The certificate itself can be a token and it can track a token. Understood. So we have these mixed forms as well. And maybe not to talk for too long, but we're seeing as well what is involving are actually mixed investments between traditional investments and digital asset investments, in that you can have now products that are basically behaving in a way of a traditional instrument, but they can give you income that is tokenized. So there is the aspect of actually taxation of an income that is indeed a digital asset. So we're permanently adapting our model to also classify such investment products. Very good, very good. Thank you very much, Jörg.
Robert, want to hear from you as well. Before entering into the tax analysis, right? How do you see, digital assets evolving and also impacting traditional finance? Any high-level overview from your side?
Yes. And you already, and it has been addressed, if we differentiate cryptocurrencies, probably from a tax perspective, up to a certain degree, plain vanilla. There had been a lot of discussion, what are these assets, yes or no, are these valuable assets, yes or no. Some discussed a lot, these are nothing, even from a tax perspective, even if they are, let's say, assets from a financial investment or speculative perspective. So, therefore, it's straightforward applying standard, let's say, tax law to cryptocurrencies. how this is reported. This is then a question with CARF and how the tax authorities track this. The more evolving tokenization, it's typically that the underlying are not too complex. So we are talking about structured products, or even if you have, let's say, a digital asset with an underlying or referencing other digital assets, also from a tax perspective, probably not too complicated. At least we have, in a lot of jurisdictions, clear guidance in this respect. What you addressed, what is the promise of DLT, and what was also, let's say, my personal, talking a little bit later probably about how this might evolve, how this might change the overall, let's say, financial service industry. This would have significant impacts on let's say, business models, other tax issues, and then really digital assets, probably referencing real assets, or providing for complete new services. And there we are still on the, let's say, testing phase. So I think the ultimate, or the promise of this new technology hasn't really grabbed too much, let's say, or the impact is limited, to put it this way. I think the impact, and hopefully we can discuss it, will be very significant also from a tax perspective. But nevertheless, so to make long talking short, cryptocurrencies from a tax perspective, up to a certain degree, plain vanilla. How to capture and track all the investors on a worldwide basis with their wallets and so on. That is, of course, from a tax compliance side, a very big issue.
Very good.
But this I have to mention with OECD and so, etc. New asset classes are emerging, and you see how quick, let's say, on an international level, but also on a national level, the tax authorities are on the learning curve and probably already accelerate the market up to a certain degree to capture the values and the taxable amounts you mentioned.
Very interesting. Thank you very much, Robert. So, Michelle, I want to double click with you, and I mean, you are in a unique position working at the OECD, and tell us your insights. I mean, what is what you are doing there at the OECD? I mean, let's go deep into your job, right? So tell us something interesting.
Okay,
you guys are doing.
that's a challenge. No, so to take a step back to look at the tax work that we do at the OECD, there are various kinds of work we do. My director likes to divide them into what she calls buckets. So we have one bucket which is the standard setting and the implementation of standards. In this context, that is the Crypto Asset Reporting Framework, or the CARF. We also have another area, which is more my own background, which is on think tank and comparative type analysis across countries. And then we have yet another bucket, which is providing a platform for exchange across countries and providing capacity building, particularly for developing countries. And our crypto asset work and our work on digital currencies falls into all three of those different buckets. So in terms of the CARF, as you will know, that was developed by the OECD with strong support from the G20 and published in 2022 and then to the Indian presidency in 2023. It builds on the Common Reporting Standard for other financial assets, the CRS, and its goal was to bring the reporting on crypto assets in line with the reporting requirements for other financial assets. Broadly speaking, it requires crypto asset service providers, or CASPs, to report information on both users and transactions to the authorities, who then exchange it among themselves. Given that it builds closely on the CRS, our global forum was tasked by the G20 with implementing it, and they have formed the CARF group, which is a subgroup of our global forum, to take the implementation forward. And the CARF group at the moment has 57 members, but it is open to all 171 members of the global forum to join. At present, there are a total of 68 jurisdictions worldwide that have committed to implement the CARF and to commence exchanges between jurisdictions in either 2027 or 2028. The vast majority of these, 52 so far, have committed to commence exchanges in 2027. That includes the United Kingdom. It also includes all of the EU countries. The UK, of course, has just released its implementing legislation and guidance, I think, about 3 weeks ago, if I'm not mistaken. And Switzerland.
As well, right?
Okay. And then there are a further 16 countries that have committed to undertaking the first exchanges by 2028. The second bucket of work at the OECD on digital assets falls into the think tank and comparative analysis bucket, and that's the stock take report that I did back in 2020 and 2021, where what we did was first of all look at online guidance for how countries are taxing crypto assets, particularly payment tokens. And we found that there honestly wasn't very much available. There were certain countries that were leaders: the United Kingdom, Australia, Singapore, Norway, Finland, the US. And so then we undertook a survey with our Working Party on Tax Policy and Statistics, to which we got 50-odd responses and gave us a much broader insight into how countries were thinking about this for tax purposes, even if it wasn't yet fully in the public domain. And so that study looked at the tax treatment, income tax treatment, VAT, property tax treatment, and then it also looked at emerging challenges where there wasn't a lot of guidance available, looking at CBDCs, stable coins, DeFi, and the rise of staking. One notable omission was NFTs, which were not covered in that study at all, and they were not really on our radar back then. They were not on the radar of the countries that responded to our surveys. But it quickly became apparent following publication that this was a big and emerging area that we really needed to cover. And so we did some subsequent work with our policy committees, thinking about the taxation of NFTs and how to frame that from a tax policy perspective. The most recent work and the current work that we're doing in the think tank and policy advice space is around VAT and the VAT treatment of these assets. And we have a working party on consumption taxes, which is looking to develop a framework or an evaluation framework for countries to think about how they tax crypto assets, including payment tokens, security tokens, NFTs, and related services, more broadly from a VAT perspective. And it builds on the international VAT guidelines that the OECD published a few years ago that have 100-odd countries that have implemented already. And the framework is built on the two founding principles from that framework. One is neutrality between different, so first of all, that VAT should not form a significant influence on business decisions. Secondly, that it should not be paid by the business. It should rest on the final consumer, on consumption. And thirdly, that businesses in similar situations should be treated in a similar way. And then the other key principle from the VAT guidelines that's been brought into the VAT work on digital assets is the destination-based principle in terms of who is paying the tax. And so the work is still ongoing. The clear direction of travel at the moment is that we see across the OECD that the VAT treatment of payment tokens is that they are treated as functionally equivalent to fiat currency. And that means they're outside the scope of VAT when they're used to purchase goods and services, and they're exempt when they are traded with fiat currency or with other virtual assets. And that the goal of this treatment, the advantage of this treatment, is to preserve VAT neutrality and to ensure that the means of payment is not subject to VAT, it's only the final consumption. In terms of services connected to crypto assets, they've looked at mining, staking and minting, they've looked at DeFi and centralized marketplaces, and they've also looked at NFT sales. And concluding, in many cases, they are outside the scope of VAT because there is either no obvious customer or no obvious supplier. But there are some exceptions to this, like wallets or centralized exchanges, which may be subject to VAT. That work is underway. It's been going on for a couple of years in our working party, and we hope we will have some form of public reference document in the next year or so. It will be discussed at the Global Forum on VAT, which will be held in Paris in January next year. And the third bucket of work, very briefly, at the OECD on crypto assets is to provide a platform for tax administrations to exchange among themselves on the challenges and best practices that they are finding in relation to the taxation of digital assets and in relation to blockchain technology. That's primarily done through our Forum on Tax Administration and some of its informal subgroups. and it's relevant to the broader discussions they're having at the moment on the digitalization of tax administrations, or as they like to call it, the Tax Administration 3.0.
Michelle,
Voilà.
breathe. You guys have your hands full, right? So, wow. Okay, quick question. Are you getting from the industry the support that you need?
We have
Short answer.
Short
please.
answer. Okay. We have a lot of engagement with the industry, in particular through
Okay.
our BIAC
Right.
business at the OECD forum, and the industry is typically very responsive when we call for
Okay.
consultations and
You
inputs.
have the right support from the industry. Okay, very good. Thank you so much for your insights. And clearly your hands are full on all the regulatory and tax analysis on crypto, right? And digital assets as a whole. Jörg, I want to double click a little bit more on what you guys are doing on SIX. I thought was very interesting as well, the comments that you mentioned on tokenization. So tell us a little bit more about it.
So beyond being a global data provider with SIX Financial Information, SIX Group actually has also a business unit that is an exchange. It's the Swiss exchange. The BME group is also part of SIX Group. And in those exchanges, obviously, digital assets themselves are also something that we look from different regulatory perspective. We have, for example, a market abuse supervisory solution called CCAM that can be used for market abuse on crypto trading. What we're really seeing in terms of like where taxonomies come together is tax in a way has been the driver for other regulations as well. So we have different types of reporting requirements for crypto assets. For example, in Switzerland, that is carried out by the supervisory, the FINMA. Mm-hmm. And again, it's based on really the taxonomy of the digital assets. Mm-hmm. So tax authorities have basically said you can have 3 types of tokens: payment tokens, utility tokens, asset tokens. And that's what is being carried through as well as kind of like binding taxonomy for regulatory reporting. And the other aspect I would like to point out here is in terms of identifier that are used for virtual assets. Yes, we are all working financial markets services. We know that there are security identifiers. What is commonly used now are really those digital token identifiers. They are being issued by the Digital Token Foundation, and it's actually the obligation of the, if there is such a thing as an issuer of the token, to apply for this. So what I want to share here in terms of know-how as well, you can have one digital asset represented as a financial product and multiple DTIs, so multiple virtual asset identifier. And I think this is something from a practitioner's point of view, when you're looking into reporting on crypto assets, when you're looking into possible CARF reporting, to consider as well that you have to deal with another type of identifier that you need to aggregate up. Mm-hmm. So this is, in a summary, just outside the pure SIX Financial Information business, what we're working on.
Very good. Thank you very much. Very useful. Robert, I mean, you are bringing a very different perspective, right? As a tax advisor, consultant tax advisor, how do you see, these conversations that you are having with your clients, prospects? What are the questions that you are getting? What are the considerations that you are looking at from the tax point of view? Tell us a secret.
There is no secret, but probably to give you what is our route, or what has been also my route, let's say, into this direction, and gives some insight. The underlying technology of Bitcoin, I think it was as really the promise. Let's say the financial service or the industry here is built upon regulation to establish trust that if you invest through various change, the ultimate asset really belongs to you. And there has no, or the technology is with the custodians and so on to provide all these, to ensure that you are really invested in this asset. And with, let's say, the technology or the underlying technology of Bitcoin on the blockchain, smart contracts, etc., probably these intermediaries, which are built upon regulation to establish this trust, you do not need trust anymore. Or the trust is transferred into, is provided by technology. And this was, let's say, a very interesting idea when we started this, and then you talk about tokenization, first on-chain and then on real assets or new services, and how this might come out. And the background had been, let's say, we started in asset management. The idea now it's slowly emerging funds on chain, to put it this way, or tokenized fund units. And we started in 2017, it was 2017 in the IBM blockchain garage, let's say, really not to establish the blockchain as such, but to code smart contracts to capture, let's say, the tax solutions. Because the idea with electronic or with electronic euro or whatever, you will have automatic payments, which will take place. But you know, these type of structures are very slowly emerging. So this is still in testing phase and so on, which is going on.
Yeah.
And probably this was, so therefore we see, had tried this, we are still, we are advising on how to do reporting and so on, definitely yes, but this is, let's say, the underlying, in essence, what is driving us, or from a, let's say, intellectual perspective. What also has been interesting, if you try to code, let's say, into smart contracts, you have to make it a little bit, or the systematic is slightly different than if you come with just your legacy assets.
Yeah,
you have to think about, you will not replicate just what is the idea of the existing legacy, let's say, environment from a tax perspective and from an asset perspective, but how to probably remodel this to have efficient smart contract templates. So it's like a app store, ultimately, from my perspective. Investor, click this together, and then you have the electronic outcome.
Yeah, that's very
as long as this is not functioning, of course, the tax authorities now, and this is very, very helpful, this curve, they are setting, let's say, the framework, what has to be reported. And so there is, let's say the intermediaries, they have to provide a lot of data. But this is just the data, and then the tax calculation and so on will be run differently. And, this is slowly emerging, and I'm already talking too much, but what is really fascinating, let's say, it was 2 years ago, I think, KKR, they announced that a new infrastructure fund they are raising, that they want to tokenize this fund. If you apply standard, let's say, tax compliance for your investment in a partnership, and then you fractionize this, which can be traded on a daily basis, you see that there are inconsistencies from a tax perspective in the future, which has to be addressed from probably both sides. Either you stay with the, let's say, typical partnership model for alternative investments, and let's say a partnership with all the issues and so on. These are not intended to be highly liquid. To apply this tax system for tokenized fund units, it might derail the innovation in this respect. But on the other side, if you just say, okay, this is probably an asset, and we just capture the cash outs and that's it, you create significant arbitrage opportunities. And how to balance this, I think, will be very interesting discussion.
It's a great conversation, and you guys are touching, and I want to jump into the question that we had on the blockchain DLT technology, right? Because you are touching on it, and a little bit one of the key challenges that we are facing in financial services is the withholding tax processing, right? So all the investments that we are having cross-border and all the traceability of data, etc. Right? So I want to ask you, how do you feel about? I mean, do you think blockchain, the DLT functionality, can add value to the end-to-end withholding tax processing? Is this a long shot? We know that there was, in EFAMA, there was a working group, a blockchain and tax working group, that they were analyzing this. We know in some way that FASTER has been coming up through this analysis of the digitization of the withholding tax processing, right? So any thoughts on the technology itself? Anything that you guys feel can add value from perspectives?
If I'm going first, I'll take it from the perspective of what we see tax administrations using DLT and blockchain for. There are a number of potential use cases, withholding being one of them, also data sharing between taxpayers and the government, as well as across the government in a secure manner, plus as just looking at the history of transactions, which can be useful for tax administrations. But in practice, we actually don't see a lot of tax administrations that are currently using DLT or blockchain technology. So every year we run a survey together with the IMF, CIAT, it's a Latin American organization, IOTA, and the Asian Development Bank, with 179 jurisdictions covered. And one of the questions that we ask is about the use of innovative technology and of blockchain or DLT in particular. The most recent study, which came out last year, it's a couple of years old in terms of the data, shows that there's only roughly 6% of those 179 countries that are actually using blockchain technology as part of their tax administration. There's about another 4.5% that are in a trial implementation phase, but overall nearly 90% of tax administrations are not. And the questions go all the way back to 2018, and it is increasing slowly. Back in 2018, there was only 1% of tax administrations using it, and 95% were not even considering it. Some of the examples we're aware of, in the Netherlands, there's a partnership with the private sector to build a company passport, which allows businesses to store their data securely and to share it securely with the tax administration, but also with banks. There is, in Brazil, there's a blockchain system that is used to manage the transfer of taxpayer registry information across government, which they're required to do, both to the customs organizations and also to subnational governments. And in Chile, they're using it for invoicing purposes. But what we're seeing anyway at the OECD, what the Forum on Tax Administration is seeing, is that it hasn't really taken off yet. And they think there's two reasons for that. The first is that you really have to invest to get it going, both in terms of money, but also in terms of upskilling your workforce. It's not easy. There are a huge range of potential business uses, but it's not easy to see where it can be most cost effectively deployed, or necessarily what the cost benefit trade-offs are in advance. And then the other reason that can be limiting it is the data protection requirements for tax administrations and for taxpayer data are necessarily very strict, and that can also limit adoption.
Yeah, that's a great point. That's a great point. Thank you very much, Michelle. From your perspective.
I risk to give a very long explanation. I said 5 minutes. So I'm trying to keep it going. So I've been talking a lot about asset classification on the financial product. Another content type where SIX financial information is very strong is with corporate actions. So corporate actions, anything from, the payment corporate actions, obviously, fund distribution, dividends, interest payments. And about 7 years ago, we thought, if you have a unique identifier that's your financial product, then surely all those corporate actions should be linked to that identifier via blockchain. So there was really early thought about using the technology. Now, that hasn't kind of evolved towards a product, also not in our product delivery, but what we're seeing now is a revival with issuers of exchange-traded products that can be crypto products as well. And hence what we're seeing is really the need to handle traditional corporate actions, such as a coupon payment on a structured note, but also new types of corporate actions, airdrops, forks, staking, as a corporate actions method, a blockchain corporate action. So this is something that we are heavily investing in and partnering with at this point. So really, in short, the more dynamic aspects of digital assets to handle them as well with data.
Very interesting. Thank you very much for sharing. Robert, from your side.
This is reflecting, let's say, my experience or to build a blockchain purely for tax purposes. I think there had been some, let's say, advances or some tests. I think makes no sense. Either you have a permission blockchain or, let's say, non-permission blockchain or Bitcoin ultimately, and then you have to have an origin business case. And then if this original business case is run on blockchain, tax is, from my perspective, up to a certain degree, I'm now degrading probably tax, but the end of the value chain. It's a reporting issue. And probably to direct payments either to the tax authorities or to the investor, to put it this way. So it's an auxiliary reporting topic which should be covered by a smart contract. But the original case of the blockchain, there has to be really, let's say, a business.
It needs to be wider than tax.
Much wider business, let's say, reasoning, because the investments are too substantial. And what is the idea that an indefinite, probably exaggerating number of participants can use this with a fraction of. Now this comes up with the, let's say, exchange-traded funds or exchange-traded structures, and it is slowly evolving. And if, let's say, really business reason, and this is what I also addressed a little bit, just to replicate the existing framework of the financial industry, just for tax purposes on a blockchain would be much too expensive. And this is even just to build Me Too products, which are very good captured in the current environment, just to replicate them on a pure blockchain environment, too expensive, no one will invest. So we are looking for new, let's say, service product developments, and if these service and product developments will arise or will be managed via blockchain or DLT structures, then it makes sense to add, let's say, the smart contracts and so on, what might be necessary, or the oracles then to extract information and so on. And this will be, from my perspective, the development.
Very good. Guys, we're
just one
very quickly, because we have just 2 minutes, and I have one final question for you guys.
Yeah, so sorry. And then we will see, up to a certain degree, let's say, the merging. And so, let's say, this will be parallel worlds, traditional financial versus blockchain. And then it's a question which, let's say, will be more successful and derive more investment income and value, and the future, where's the future value proposition? And then we will see, but it's a long time parallel.
Both works together, yeah, that's very useful. So guys, I'm the moderator, I have superpowers, and I'm gonna transfer my superpowers to the 3 of you, okay? And now you have superpowers, and you can change, add, delete, whatever you want to do in the existing regulatory and tax framework for digital assets. 30 seconds, each of you. What will you change, add, delete, or do with your superpowers? Michelle.
As an official from the OECD, I'm going to magic us into the future, say 5 years, where we have CAF implemented widely, where it's functioning as intended and living up to its promise.
Okay.
But more importantly, where it's gone beyond that and has been a sea change for both the industry and for tax administrations alike, making the tax system more nimble and responsive, while achieving the aims of it, and also just increasing the social contract, the trust between the two sectors.
Okay, very good, very good. Well done with your superpowers. Jörg, what have you done, or what do you want to do?
It's not really superpowers, but it's just a hope, I would say, that it's just that digital assets and blockchain technology will bring us to the point where we can have in terms of financial products that we invest in, a new pattern. So it's not no longer kind of like a pure distribution pattern, but that it becomes normal to invest and divest into
fully
into
integrated, right?
digital assets that you're not kind of like depending on data being shoved down the line to you.
That's a great
kind of
point.
like
That's a great hope.
maybe
Full
a dream.
integration. Yeah, very good. What are you doing with your superpower?
Even if I have superpower, I cannot predict this future. So I think with the...
You have the superpower to predict the future. Come on, use
so
it.
what will, let's say, what will happen up to a certain degree is, let's say, with this regulation, let's say, standard features of the business will crumble and really, let's say, it will be a complete different outcome. So we are, and this is a fascinating time, at the edge where, let's say, innovation will change completely, or not completely, but significantly, the regulatory setup. This will, and also taxation setup, I can talk about it. And this will create, on one side, opportunities, probably as a society we should grasp, but on the other side, this will trigger risks, and we have to be very agile for these risks. But this information, let's say, this innovative phase gives both, let's say, it's a chance, risk, opportunity, and how to grasp this as business, as society, and then also for the taxpayers.
Yeah, grab the opportunity.
One question in this, we currently talk about financial assets and digital assets as financial products. But if we go a step further, this will completely blur the line between standard products and financial products. And this gives an idea which regulation should be applicable. If I drive a car and I buy a car, it is not a financial asset.
We need another hour to keep talking. Yeah? We need another hour.
Sorry.
Guys, I want to thank you all for your insights. I think these guys deserve a round of applause from all of us. So thank you so much. Yeah.